Welcome to the penultimate episode of Essentials for Financial Advisors for 2020. I think it's only poignant that being the end of 2020, that this session is about looking forward into 2021. We've got an exciting session planned today. For those of you that don't know me, my name is Dale Franklin. I will be hosting you on today's journey. Please put your questions in the Q&A. I would expect that there'll be a lot of share questions today. We will try to cover as many shares at the end as we can. We have Peter Armitage on today. Peter Armitage is the CEO of Anchor. We also have the analyst team joining us who will be taking us through the top picks for 2021 in the JSE. So without ado, I will hand over to Peter.
Okay, guys, we decided to do something a little different today. A lot of the conversation is about macro discussions and Biden and Trump and vaccines, but ultimately we don't buy indexes, we buy shares. And what we've done is got our analyst team to talk through some shares that we think are particularly attractive in the South African environment. We've also had a lot of focus on global shares, on tech shares and the like, but we're going to focus on opportunities that are listed in South Africa and some that have their own kind of investment attractions, and some that are a function of SA Inc. and where we think you should be positioned if the recovery continues. So as a short summary, I think we want to make the point right up front that we favor global equities. SA is ultimately in a low GDP growth environment, we think, for the next 5 years. But within SA, there's some very interesting opportunities. And in fact, on the market over the course of the last month or so, you've seen that's where the action's been. There's a lot of value if South Africa thrives. And then towards the end of the presentation, not something we can fill our portfolios with, but some really crazy small cap valuations and some nice ideas to make money. We then asked the question, SA Inc. has bounced, but where to now? And as I said to you, this is really an indication of 10 specific share opportunities. Just one of the points to make you realize how unbalanced our market is, NASPERS made the point in a recent interaction with them, that if they traded at net asset value and grew at 20% per annum for 3 years, they'd be 60% of the South African market. So those are the kind of complexities we faced with in the market. Then just to remind you of what's happened in our market. So this is the capped SWIX, where we're projecting about an 11 or 12% return from SA equities over the next 12 months. And just showing you to end October, the capped SWIX had done about minus 13%. And in November, in a very short time period, it's bounced about 11. So the capped SWIX is down about 3 or 4%. And you can see, the real negative has been SA Inc. It's recovered about half of its decline in the beginning of the year. And the real star was NASPERS, up about 42% to end October. But inevitably, it's not going to be the best performer in every time period. Then looking at global outcomes, global equity markets, we think, are looking very fully valued. There are a lot of reasons why it can continue to go up. I think there's a lot of positive momentum. But from a pure valuation perspective, we're projecting kind of mid-single digits dollar returns from global equities. And then the chart on the right, just showing you year to date where the action's been. Obviously, all in the NASDAQ and the technology shares, with real estate, financials, etc. at the bottom. But month to date, you've had a rotation where the beleaguered shares and the kind of COVID unfriendly shares have been where the action is, with a smaller return from the NASDAQ and the like. This is a reminder, and the index that kind of sets the benchmark for the world. The S&P started the year at 3,200. It then went up to about 3,400 and is now trading at an all-time high. So what worries us a little bit from a valuation point of view, if you look at the two charts on the right, McDonald's and Nike, shares which we don't think are worth a hell of a lot more than they were before COVID, but trading at 10 to 30% premiums. So the good shares are certainly getting very high ratings, and with money being quite cheap, people are indicating that that's justified, but some caution is warranted in terms of index levels. In talking about SA equity markets, we always have to talk about the rand. We think it's now close to fair value. All the way from 19, we were saying, we expected the rand to head below 16 with a fair value of around 15.50. And this is our purchasing power parity chart, with the blue line being purchasing power parity and the light blue line, the bar on either side, being one standard deviation. So we're getting down to one standard deviation away from long-term fair value. So in summary, from an SA equity perspective, we're going to show you that we think resources are still pretty attractive. They're very cheap, and Seleo is going to tell us about Sibanye. Very cheap relative to spot prices and churning out a massive amount of cash. And that really is underpinned by the global infrastructure stimulus being led by China, which is obviously the key driver of resource prices. So I think the market's very cautious, otherwise the prices would be a lot higher. But if prices at these sort of levels can be sustained for a reasonable time period, there's still some more action. Mike will take you through NASPERS, where we think there's absolute discount exhaustion. Nobody really cares what the discount is. But at that point in time, it's often the time at which discounts can narrow. And management have certainly indicated strong intent on doing things to narrow the discount. A lot of the things relying on regulatory agreement with various authorities that are impacted. From a domestic equity perspective, we don't think, it certainly hasn't been for the last few years, and we're not convinced going forward that kind of your buy and hold strategy of, the big blue chip banks and retailers will make you a hell of a lot of money over an extended period. But we are seeing lots of big moves, and there is money to be made. In the Rand hedge sector, that's kind of your British American tobaccos and Richemonts and the like. They're obviously not homogenous. They've got their own company-specific drivers, and there are some attractive counters in that space. Then, just to make the point, it was interesting to me. There was a Financial Mail article asking 17 asset managers around the country a few weeks ago, where they should keep their money for the next 5 or 10 years, and not one of them made any mention of Asia or China. And we think Asia, if you look at the graph on the right-hand side, it's GDP growth in developed markets, emerging markets, and South Africa. So the biggest growth certainly from the emerging market space. You've got to find the places that flows through into profitability. But ultimately, on the left-hand side, so the South African weighting in the Morgan Stanley Emerging Market Index is coming down and down. And in 10 years' time, there'll really only be 2 markets. 70% of the world will be US and Asia. And I think South Africans and South African asset managers underappreciate where the action in the world is coming from. And it's important to realize in buying the SA equity market what you buy. Here we've got all the different sectors broken down the way we break them down. And if you then aggregate into South Africa, emerging markets, and global, about 44% of our index is South Africa driven, about 42% is emerging market driven, and 5% global. So to understand, when you're buying South Africa, you're effectively buying just less than half SA, and then the rest is basically emerging markets with a big commodity weighting. And this is a chart I've used in a few of our presentations. I'm not going to go through in detail. You're welcome to get a copy of this presentation, but we just go through each economic driver in the South African market and what we think the earnings can grow by over the course of the next 5 years. And we land up with a kind of a base case of about 6% earnings growth. And that's not particularly exciting. But within that, there are very good specific opportunities, and that's what we're aiming to identify today. So news that came through yesterday that I found quite interesting is that the UK, for example, has now indicated that no petrol cars will be sold in the UK after 2030. And that's just around the corner. They've just pulled that back from 2040 to 2030, and the realization that electric vehicles will be available commercially in a shorter time period than what they thought. So again, you've got to have a look at things like platinum and the companies that are impacted. So moving straight into the shares out there, we're going to get 5 of the other analysts to talk about different companies. We're going to hand you over to Seleo, who's going to talk through Sibanye-Stillwater. This isn't really a SA Inc. story. It's a global precious metal story, but we think it looks like good value. Seleo, over to you.
Thanks, Pete. Hi, everyone. Yeah, so I suppose with Sibanye, when this first listed, it was a pure gold company, and things have changed a lot since then. So today it's one of the biggest platinum and related metals producers in the world. It has operations in South Africa and the US. And what's really interesting about this business is that it's quite different to what we usually look for. We tend to look for businesses or companies that can structurally grow over long periods of time. This is a bit different. This is a company where the fundamentals have been getting better for the last few reporting periods. And although the share price has appreciated, it's quite badly lagged the improvement that we've seen in the fundamentals. So if you look at the graph on the bottom right, the earnings before interest, tax, depreciation, and amortization, because the price of platinum and related metals has improved significantly over the last 2 years or so, we now have a situation where the amount of cash that's being generated by this business has improved significantly. So on an annualized basis, Sibanye is now generating about 40 billion rand a year in cash flow. That was 30 billion for the first 9 months of this year. And today we're sitting with a market cap or a valuation on the business of about 150 billion rand. So if you look at it on a PE basis, it's roughly 3.5 times, 3 to 3.5 times. And there's a few reasons for it. So firstly, a few years ago, the business did have quite a bit of debt, and that made people pretty nervous. If you look on the bottom left, you can see the net debt chart there. And at the end of 2018, you had roughly 22 billion rand in net debt. And the market was looking at this and thinking, okay, we have a cyclical business, a large amount of debt, and we just don't like this combination. And so rightly so, the valuation was quite low on the business. But because of this massive increase in the PGM or the platinum basket price, Sibanye was able to aggressively pay down that debt. So they said that at the end of September, they had roughly 3 billion rand of net debt. We think that today they actually have no debt. They're likely to be in a net cash position where they actually have no debt. And they're likely generating quite a lot of cash on a monthly basis, given how high prices are. So that's the first concern that has been put to rest by the fundamentals. But again, it's a situation where the fundamentals have improved, but there's still a bit of skepticism. The second is around potential M&A or acquisitions. So the market's concerned that because they're now generating all of this cash, what chance is there that they might go and do a large acquisition? We think that given the valuation at 3 to 3.5 times earnings, something has to give in the sense that you can't have a business generating roughly a third of its cash flows every year if prices are to be maintained for a short to medium amount of time. You really can't have that being sustained without either the valuation moving higher or the commodity prices coming off. So this is a situation where it's a bit different to what we typically look for, but within the South African context or environment, we think this is a very exciting opportunity. And that's really Sibanye.
Okay, hi guys. I'm going to take you quickly through Discovery Holdings Limited, another share we own across portfolios. I guess the story with Discovery is one of a huge structural winner in South Africa that's managed to, over the last 20 years, capture a big part of the sort of mass affluent, longer-term insurance market and health insurance market in South Africa. I think that they could be considered as pioneers in terms of what they do. And I think for us, what's really important when sort of analyzing its track record is that over the years, they've managed to tick many of the key sort of investment pillars that we look for in portfolio companies. So they've sort of got what we would consider key ingredients right over the years, a differentiated product driven by innovation. They've got alignment between the client, the end client, management, and also the sales force quite well balanced. And then obviously what we also look for is the ability to reinvest back into that winning formula. And I think that if you look at Discovery, it's one of the few examples on the South African market over the last 10 years where South Africans can be quite proud in terms of what this business has achieved and in what it actually represents on a global scale. So I think that the shared value insurance model, which is now being exported around the world, is something that we could consider proudly South African and a secular winner and something that we're backing longer term. As you probably know, they've gone into banking, and we don't think that the outcome will be any different to the way it was for them in health insurance and long-term insurance, where they were able to capture and disrupt the market that they entered. But then ultimately another key consideration for us is the ability to match the business case with the investment case. So the ability to justify how the stock's trading, where it is in its earnings cycle, and just to ensure that we're not overpaying for it. And as you can see, sort of our approach in terms of the way that we build up a reasonable check in terms of the price that you're paying for Discovery now. We've kind of taken what is quite a strange year, obviously, with what's going on in financial statements, where companies have had to provide for sort of quite anomalous or once-off provisions, creating potentially distorted earnings or a shorter-term earnings trough, and then tried to normalize that. And we, in terms of what it would look like if there was no COVID-19 issues, and then try and sort of come to some conclusion that the real earnings number is somewhere in the middle of those two, and also not penalize them for the fact that they're one of the only companies in South Africa that's invested quite a lot of money in terms of growth and new initiatives over the last few years. So loss-making businesses we wouldn't want to place a multiple on. So just going very quickly in terms of the core businesses that are quite profitable and maybe entering more of a mature phase in their life, if we place that on a 12 times earnings, we place the investment that they've made into the bank. We pay at NAV for that, amounts to about R6 a share. Vitality Group, which is now their sort of quite high growth exports in terms of the shared value business that they've got in South Africa. If we place that on 5 times operating earnings, we get another R3 a share. And then the real excitement in the business, which sort of adds the real optionality in terms of future growth, is their JV with Ping An Insurance in China. So they've got a 25% stake in the health insurance of Ping An business. And I mean, that business is exploding and already generating 7.5 billion rand in revenue and contributing about 180 million rand in operating profit attributable to Discovery. So very difficult to know what kind of value you would place on that business. But what we sort of conclude is that if you back out what the existing businesses X that come to, and it roughly equates to where the stock's been trading at over the last month, it means that we don't feel we are overpaying for the optionality that Ping An does provide within the investment case. So I guess that's an exciting opportunity, I would say, for a longer term sort of compounder in South Africa.
Thanks, Liam. That's I'm sure most of you know, but that's Liam Hector, who runs the Anchor BCR Equity Fund with me, and some interesting perspectives there on another share. Then getting into the kind of COVID and vaccine plays on the South African market, and it's only listed in South Africa, but is a truly global business, which is BIDCORP. BIDCORP is a food services player. So to understand what that means, if you're running a restaurant, instead of shopping in 20 different places and getting 50 different suppliers coming through, they consolidate everything, they source the product and deliver what a restaurant needs. If you look at the chart on the right-hand side, about 36% is in fact restaurants, and there's obviously lots of different industries like healthcare, education, hospitals, etc., that it services. As you can imagine, this business came under big pressure during COVID, and the charts on the left starts at 100, and you can see that during COVID, sales went down to about 40% of what they were before, but in many instances are recovering quite sharply. BIDCORP is a fantastic business. We love the cash flows, great management, good business model, good returns, and it's a company that we typically would own at most times in our equity portfolio. What was particularly impressive during the COVID period was the way they were able to flex their cost base. So they still remained profitable despite turnover going down by about 50% in certain periods. And they'll kick that up quite quickly as things recover. So BIDCORP is a classic example of something that we think will be worth as much before COVID, as much after COVID as before COVID. What was it worth before? The share price was about 340 Rand. And if you price the currency into that, it's only about 10 or 15% South African. That's the equivalent of about 380 or 390 Rand. And the share price today is trading around 270, 280. So, we think you can get an excellent return from this business over the course of the next little while. And we also think it's got a good chance of coming through as an even stronger business afterwards. It's got a very strong balance sheet. It was 0.5 times geared. Sorry, not 50% geared. It's debt to EBITDA. So very manageable debt levels. And we think they're in a very good position to acquire some other businesses and emerge as an even stronger business. So we like that as a good example of the opportunities that still exist, both on local and global equity markets, in the space where the market is not yet fully discounting what's coming. I see today Pfizer have just come out indicating a 95% success rate with the vaccine. So there is an end to all of this, but there's still a bit of a rocky road to go. Then moving into the retail space, the South African retail market has exceeded expectations. I think people were expecting the worst, and Stefan Engelbrecht is going to take us through two shares that we like in that space.
Cool. Thank you very much, Pete. So now we're in the domestic part where, as Peter mentioned, this is probably more of a you don't marry, you tend to date. And we're highlighting two stocks that we believe, with the current environment that we're seeing, is definitely benefiting and will continue to benefit in this climate. So first off, let's start with Mr. Price. The chart on the right-hand side, it shows you the year-on-year sales growth of the various clothing retailers that have reported thus far. You can see on the left-hand side in April, because most of them were closed, you almost saw 100% drop on all of them. And then subsequently, as the lockdown measures started to be relaxed, there's a very clear trend that we see. And if we can bucket together Pep Stores and Ackermans, Mr. Price, and then Pick n Pay clothing, there's a definite indication that the consumer in South Africa, although they have, as Peter mentioned, outperformed expectations, not all animals were equal here. There was a clear shift to perceived value as the consumer remains under pressure due to the economic impact of the lockdowns. So we do prefer these value-orientated retailers at this stage, and Mr. Price squarely falls into that one. Pete? Yeah. So if we just break it down into the opportunities and the risk, I mean, all of these retailers, given the economic environment, do have some risk to them. But focusing on the opportunities first, given the risks, we like, in the current environment, companies with very strong cash positions or very strong balance sheets. And Mr. Price is one where just over 14% of their current market cap they have in cash. They have committed to returning this cash to shareholders, and they have dismissed any talks of offshore expansions, having seen how so many of the South African companies, Mr. Price included, have burnt their fingers in the past as they tried to expand offshore. So Mr. Price has committed to returning all of that cash to shareholders. Also, Mr. Price is a very well-perceived value retailer. The South Africans have accepted Mr. Price as offering good value at or good products at a good price. And they've recently moved into value cosmetics and then also value sports equipment. And all of these new ventures are progressing very well, and we see future growth. On the risk side, clothing is still discretionary. So if we continue to see the lackluster economic growth, and especially the unemployment rate doesn't improve a lot in South Africa going forward, clothing it will suffer, and the consumer will shift the share of clothing in their wallet to food and other more vital products that they need to buy. Mr. Price does also trade at a premium to the other retailers. However, we believe that this is justifiable given its strong balance sheet, its higher margins, and its higher return on equity that it has achieved over time. Moving on to the next one. Yeah, so this one, I've really put myself out there by calling SPAR on the day that it reported. But happily, they did not disappoint. And the results that they reported today resoundingly beat expectations. And just before we got in, it was up about 10%. And all of these themes that I'm going to highlight now is playing out. And we do believe that this is actually going to continue to play out going forward. So why do we like SPAR? Well, three key factors that's currently providing some tailwinds for them. Firstly, home improvement has been a very strong global trend during this lockdown, and South Africa has been no exception. We've taken the bottom left chart there from the cash build results that are reported about 2 weeks ago. It shows you the year-on-year or the volume growth or the volume sales for cement on a weekly basis. Now, cash build's year-end was at the end of June. So you can see the lockdown period there was grayed out. And then ever since that period, for the first, from about beginning of May to the end of June, you can see that cement volumes were already higher than they were in 2019 over the same period. And then going into the new financial year, which is basically from the end of June to, they reported about 3 weeks ago, so this is still about October, you can see that cement volumes continue to outperform 2019 and 2020 over the same period of time, their financial year now. So cement volumes have really picked up and this is as people continue to improve their houses, as they live, spend more time at home, and also get some. It's probably a little bit of a sad fact, but because of all of the retrenchment packages, there has been a real flurry in investing in your house to improve it while you still have the cash available. The next tailwind that they're currently seeing, sorry, Pete, I just want to finish up on the next one, is the shift away from large shopping centers to community shopping centers. Now, this is just because nobody really likes wearing the mask. If you go out, you want to get in and out of a store as quickly as possible. And that is why people have started to move quite quickly or adapt their shopping pattern to community centers rather than the larger regional malls. This is a slide from the GROWTHPOINT Investor Showcase that they held on the 14th of October, which reflects exactly that. The grey bar at the top shows you the trading densities that they're currently experiencing in the community shopping centers, and then the dark purple chart line shows you the regional shopping centers. And as you can see, the community center shopping center continues to outperform the regional shopping center, and we believe that this is going to continue, and this is a global phenomenon. Okay, thanks, Pete. So opportunities and risks. So on the opportunity side, we believe that the SPAR portfolio is far more resilient than many of their South African competitors. They build it brand, which is where they play in the home improvement space, will likely continue to benefit from this home improvement trend, as well as the other important factor that we have to remember with SPAR is that all the SPAR stores are run by entrepreneurs, and there are no managers there. And in tough economic environments, you want to back the entrepreneur over the manager, where he needs to get that next rand in to pay for the school fees or to put food on his own table. So the entrepreneurial nature of the franchisee model is shining in the tough economic environment. The European expansion continues to exceed our expectations. This morning when they reported, they showed strong growth in Ireland as well as in Switzerland, and they have a lot of exciting growth opportunities with the newest expansion into Poland. On the risk side, they are very over-indexed in liquor. So Tops has been severely impacted by the liquor ban. However, luckily, this morning's numbers showed that they were more than able to compensate for this with other strong divisions. And this should actually no longer be a risk going forward. And then finally, the further lockdowns in European countries may hamper some of their growth in Europe. However, in the past few months, or in the first lockdowns, SPAR has actually benefited from the lockdowns rather than suffered from it. So overall, SPAR, we are still quite excited about, and it's one of those where we continue to invest even after the strong run this morning.
Thanks, Stefan. In the property markets, most property shares are down at least 50%, and many down a very sad 60 to 70%. Often, obviously, poses the question of whether there's big opportunity. And Glenn's going to take us through GROWTHPOINT, which we do think looks interesting.
Thank you very much, Peter. Glenn Baker here. I look after the listed property sector and manage the funds in the sector for Anchor. So what are we going to talk about to try and get through the minefield and emerge on the other side and win the war? We're going to talk about GROWTHPOINT, because I do think that there is a war to be won here. GROWTHPOINT is the largest South African real estate investment trust, market capitalization of 36 billion rand, and a gross asset value, i.e. the value of its buildings, at about 160 billion rand. Property has been the worst performing SA category over 1, 3, 5 and 10 years, and is quite close to the bottom of the hit parade over 15 years as well. If you look at GROWTHPOINT, it's less than half its value from its high of about 2.5 years ago in early 2018, and it's 40% down this year, which is more or less in line with the index, slightly better. And as Pete said, that's the extent of the sell-off in the sector. Why has this happened? I mean, there's no point in too much hindsight and rear-view mirror analysis, but it's sometimes quite important to understand the history in order to look forward into the future. So you could argue that there was some irrational exuberance. There was a lot of money, especially from multi-income and flexible income type of assets, that's chased the sector from the mid-2000s basically up to the end of 2017. Why? Because you got income, and that income grew. Dividends that grew at inflation plus levels. So it was a darling. However, macroeconomic conditions began to turn negatively in 2016, 2017. And this year, the COVID-19 pandemic, has been a significantly hard blow to the sector, as it has been around the world. Thanks, Pete. And GROWTHPOINT is quite topical, and it's quite interesting because it came to the equity market last week to raise 4 billion rand in order to pay down some debt, because clearly most property stocks, in fact all of them, would be concerned about their balance sheet and capital structure at this point, but also to keep some powder dry for opportunities that may present themselves in the current environment and climate. And no company will be better placed in the listed sector than GROWTHPOINT because it has scale. So do we think this is good news? Indeed we do. Because of that scale, it's present in all sectors, in all segments of the property market. It has now proven, if it needed to, that it can tap capital markets, both on the debt and equity side, and banks are going to want to service GROWTHPOINT. And ultimately, the strongest are going to survive and prosper over time. How do we value it, and why are we quite optimistic about the share price at current levels of 12 rand? If you look at the dividend yield going forward, some property companies are not going to pay a dividend, probably. GROWTHPOINT management are committed to being a REIT and to paying a dividend, even if the payout ratio is not all of the distributable earnings that they make. But our forecast is that the dividend for financial year 2021 to the end of June next year will be in the region of 1.20 rand. So very simple maths, at the current share price, that yield would be about 10%. And certainly we don't think that the divvy would be any lower than R1, which would give you a yield of 8. So perhaps not spectacular, but if you look at the graph on the bottom left-hand side, the 10-year average of the historical dividend yield that GROWTHPOINT has traded on is about 7.25%. The NAV is well above the share price. That's not unusual in the sector at the moment. NAVs are going to come down because property valuations are under pressure, but at a share price of 12 Rand, we think that the share price has overreacted, and that if investors are patient, they will make both income and capital growth. And there's no doubt in the sector, as in some others, a vaccine is going to help. Thank you.
Thanks, Glenn. Mark Gresty is now going to talk to us about MTN and NASPERS. Mark's an experienced hand on the market, and particularly in the telco space. And MTN is really kind of a self-help unique story, not really related to SA Inc. But Mark, I'll let you tell the story.
Great. Thank you, Peter, and good afternoon to you all. So this is probably a little bit of a controversial one, and to use the term that Stefan mentioned earlier, I would say it's a share that you definitely date and don't marry. 2020 marks, I think, 6 years now of pretty torrid performance from MTN. The share price peaked in 2015 at almost 250 Rand, and at the moment is sitting sub 70 Rand. So it's certainly been a liturgy of pain for shareholders. Why do we like it? I mean, first of all, note that, the rating right now is plumbing the depths. That's despite the fact that management are probably 3 years into as Pete mentioned, a self-help turnaround strategy, which is actually behind the scenes delivered quite successfully. So COVID has been perhaps the unkindest cut of all in terms of coming in exactly the year when we hoped a lot of this success would finally come through for shareholders. However, I think it's gratification deferred. And in 2021, we believe you're going to see a number of catalysts come through that are certainly going to support MTN. So in the short term, perhaps in the next couple of weeks, I'm hoping we're going to hear news on the recapitalization of Cell C, which is an important driver of the bottom line in South Africa. And MTN, because of the inability of Cell C to pay for services, has been unable to recognize all of the revenue. Importantly, MTN is committed to selling around 25 billion rands worth of non-core assets, the proceeds of which are going to go to pay down debt. So debt currently stands at about 70 billion, market cap of 160 billion. So 25 billion is a significant number in that context. And importantly, a lot of those assets are not contributing to reported earnings, either because they've been identified as available for sale, or because in the case of certain technology investments, they're actually loss-making. So you're not giving up a great deal of earnings through those sales. Another announcement that's come through, and one that I'm very pleased to see, is the decision to exit the risky Middle Eastern businesses. They're probably not going to get a hell of a lot for them, but at this valuation, I don't believe that there's anything reflected in the current price for those operations anyway. As we see the world gradually coming out of COVID-19 and the oil price recovering, I expect that we'll see cash upstreaming improve, particularly out of Nigeria. And with that, you should see a substantial improvement in the dividend, which at current levels would put MTN on very close to a double-digit dividend yield. And then something else that I think is underappreciated is the fact that, in a world of telecommunications companies, which are really regarded as dumb pipes and ex-growth, MTN is pretty unique in providing an opportunity to grow in areas not typically available to telcos. Typically areas like financial services and digital services are the domains of banks and IT companies, respectively. In Africa, that's not really the case. And we're starting to see some really interesting moves by these big telcos to capitalize on those huge client bases they have. And I think that gives them a degree of uniqueness that you're really going to see come through over the next couple of years. So we're really looking for a very good year out of MTN after what's frankly been an extremely difficult number of years. Moving to one that's a bit less controversial. Now, I believe that you were subjected to an hour and a half of detailed history on NASPERS, so I'll try and keep this brief. 90% of NASPERS NAV is comprised of its stake in Tencent. And as you can see in the chart on the left-hand side there, I've just given you a bit of a sense of the type of growth momentum that you're likely to see out of Tencent. And as Pete alluded to in the earlier stages of this presentation, this is our kind of banker, if you like, in terms of a dependable compound growth story in South Africa. Now, this growth is frankly no accident. I think Tencent over time has been a very good evolver, if you like. It started out as a social media PC-based platform, then introduced gaming. Around 2009, it pivoted and recognized the move from PC into mobile very successfully. And in the last couple of years, we've seen it pivot more into what they call the industrial internet. And it's areas like cloud computing and what have you that are really likely to come through to the fore and drive that growth that you're going to see over the next 3 years. But that, speaks to a significant component of the growth momentum in NASPERS. If we pivot away from the Tencent story and look at the rest of NASPERS, they've focused essentially on 3 core areas, those being online classifieds, food delivery, and payments/fintech. And I think part of the reason you've seen this discount widening, as I'll show you just now, is I guess investor fatigue at these persistent losses you're seeing coming through in these rump businesses. They are relatively early stage, and NASPERS has now been at it for quite some time. And you can see that profile of earnings over the next couple of years likely to swing through into profit. And it's one of the drivers we expect to come through in terms of improving the appeal of NASPERS as an alternative to just seeing it as a poor man's play on Tencent. And we certainly expect that over the next couple of years, you're going to start to see the growth rate in NASPERS begin to exceed for the first time that being delivered by Tencent, impressive as that is. Peter, if we could go to the next slide. And then just finally, the sort of optionality that you get with NASPERS. I've shown how the discount has widened over the last number of years and currently stands at just over 50%. It's pretty much close to the widest at which it's ever been. I think Pete used the term in discount fatigue. And what we expect is that management have committed to take further action to narrow that discount. We've seen a little announcement in the last while that they will be doing a share buyback. I say a little announcement because I don't think that is going to be particularly market moving. But they've always described the listing of Prosus, which happened last year, as the first putt and potentially a 3-putt close. And I expect that we're going to see a number of big moves from NASPERS, potentially the next being the distribution of a further chunk of Prosus shares to shareholders. Aside from that, they're looking to grow those rump businesses substantially over the next couple of years. Currently, we value them at around 20 billion in aggregate. They're looking to grow those into an aggregate around a $60 billion group of businesses. So, strong Tencent story accompanied by, let's call it, coming of age within the rump is what we are hoping for. And then the final bit, obviously, the narrowing in that discount at some point in the not too distant future.
Thanks, Mike. We have focused pretty much on the bigger shares, and obviously when markets are quite beleaguered and rising, that's where you get your action out of. But there's certainly no doubt that there's a lot of smaller companies that are sitting at crazy, crazy valuations. So we thought we'd highlight 2 of them to you. We don't necessarily hold all of these shares that we're talking about in our equity portfolios. It's got to fit in with portfolio positioning, and we take liquidity into account. But the first one we're going to talk about is GRINDROD. So GRINDROD has been an absolute dog of a share. It's gone from kind of 25 Rand to 4 Rand. It's got a market capitalization of 2.7 billion now for what was really kind of a giant of a business. The net asset value of the share is 12 Rand, with the share price of 4 Rand. So that, of course, poses the question, is the net asset value wrong or is the share price wrong? And as we've seen, you see in the property sector, there's a lot of companies around with that are trading at huge discounts to NAV, but either they need to start getting a return in the NAV or it needs to be unlocked. And we think GRINDROD is an example of a company where you will see some unlock. And we think, in a year's time, if they do what we think they can, this could be a 6 or 8 Rand share, not a 4 Rand share. So they're selling off their non-core businesses. Senvest is one, We think they'll get about 500 to 600 million rand out of that. Remember, the market cap is only 2.7 billion, and that doesn't contribute to earnings. And then they've got a trading business called Cockett Marine, about 700 million rand that they're slowly unwinding. So without taking too much away from earnings, you're going to realize over R1 billion of value. And management is quite focused on either buying back shares or paying that back out to shareholders. You're then left with primarily, and the core strategy of the business, and the chart up, or the picture I've put on the right-hand side, is being the primary trade corridors throughout Africa. That obviously has a lot of value for people who want to transport stuff. It's obviously very materials-based. On the right-hand side, you can see the kind of stuff they transport. So we don't think there's, and in fact, through COVID, this business did very well. Trading profit was only down about 5 or 10%. And as Africa frees up, we think the opportunity for trade around Africa gets better and better. So this is a company which we think has very little downside. They're going to be a big buyer of their own shares or pay big dividends. And if they can unbundle some of the stuff that they've got, there's some quite nice upside. There's also a banking business with 1.6 billion rand of market cap. Again, I point to the context of 2.7, so 1.6 billion of NAV. And they're certainly looking to sell that. And we think they might be able to achieve that in the next year. Then another one that is just crazily priced, which is ALVIVA. It used to be Pinnacle Holdings. So this is the biggest IT distributor in the country, with about 30% of their businesses in the services, much more popular services space. And they've just announced the purchase of their biggest competitor, we think at a bargain price at net asset value. And news that came out yesterday is that a consortium has just bought 16% of ALVIVA's business. So there's certainly some corporate action around. And we think you could well see potentially, and we speculate here, a buyout of the company. To put the valuation in context, the market cap is about R1 billion, and the company generates around 400 million rand of free cash flow in a year. So they'll make the entire value of their business back in about 2.5 years. No balance sheet issues, a very strong balance sheet, and effectively, so we think in the year that we're in now, ending June 2021, they can make around R2.60 a share. And the share price is R8. So that's a current multiple of about 3 times. So this is one, if you see some action, could easily be worth double the price. Another small company in share, we're kind of spending a lot of time out there talking to CEOs of businesses to see where there's value. A very small company, 200 million rand market cap. Haven't put a slide on it, but is Sepaku Cement. And they're having an absolute dream time. They're making more money than they've ever made before. And management really, I had a call with them and they were kind of looking quite demure. And I was, they can't supply the cement demand that they've got at the moment. Most of you would have followed the construction industry, we think is in for a bit of a kicker, and we're looking at companies in that space. And in addition, a lot of their competitors are having issues. So they were locked down and closed down and not operating if you go back to kind of March, April. And now they're having absolutely boom times. But I guess they're a little bit nervous of how long it lasts. But to put that in context, the market cap of the business is 200 million rand, and they're generating around 50 million rand a month in free cash flow. So that's a 70 cents share. We think that, if you're really taking a bet on the SA infrastructure story flowing through, but if it does, this could easily be a 2 rand share in a year or so. Then GROWTHPOINT, which is the biggest shareholder in the business, offered 4.50 rand a share, and that was only about 18 to 24 months ago. So we obviously focus on the bigger companies and want to get those right and keep the liquidity in our portfolio, but there are also some very interesting smaller companies out there. So in summary, we wanted to talk specifically about SA listed shares. I think a lot of people have ignored those in favor of global equities. We do think over time there's going to be a focus in global equities, and our Anchor BCI equity fund, we're sitting with close to 30% in global equities, and we like that positioning. But South Africa has certainly got some very interesting opportunities, and today we've aimed to show you some of those. There's great value in many instances if SA thrives, and there's also a lot of idiosyncratic specific stories, I guess, like an MTN, where we think there's nice value being unlocked. And there's also some crazy small cap valuation. SA Inc. has bounced. We're going to watch quite closely. SPAR results out today indicating that there is continued momentum. And we've enjoyed the opportunity of taking you through some specific opportunities. That's our disclaimer, which you can read very quickly, or you can read when.
Thank you, everybody. The floor.
Thank you very much.
The floor is now open for questions. Just firstly, thank you very much for Peter for making time for us. We know that this has been a particularly hectic week for you. So just a very big thank you. Guys, if you could write your questions on the Q&A now. Oh, okay, so I see questions are coming through. Glenn, a question for you. Where do you think property from a broader perspective will be in 5 years?
In terms of the share price, I think your internal rate of return would be double digits. So I would say doubling it would be a conservative call. So I think what the property sector has proven is that it is cyclical. It can be very, very volatile. It can hurt you as well as help you. But the fundamentals will return to normal. And once the bottom is formed of the distributable income that the property companies can pay out, and once that starts to grow, the first indication of that, I think will be very positive for the sector. And I would say comfortably it would be double what it is now in terms of capital value in 5 years' time.
So Leo, a question for you. Will Sasol recover from where they are now, and how long will it take?
I don't think Sasol will get back to where it was pre kind of this fallout that they've had, partially because if you look at what they've done, I mean, they've sold half of the base chemicals portion of Lake Charles. So structurally, it's a different business to what they were hoping it was going to be. But I think perhaps what they do have going in their favor is that the capex going forward should be quite a bit lower. So they're not spending, I think they peaked at around 60 or 70 billion rand of capex on Lake Charles per year for a couple of years. That's going to come down quite materially to around 30 billion rand. And that should help free cash flow, which should be positive. But I think the business won't be as big as they would have hoped it would have been, because they've had to do this. They've had to sell off a portion of Lake Charles to sort out their balance sheet. And there's still the potential for a rights issue.
Thank you. Liam, a question for you. Can you comment on the recent 2 billion bond issue from Old Mutual?
Unfortunately, Liam needed to leave, so somebody else can take that question. That would be great. Or move on.
The analyst team take that question. Okay, I see no one that wants to. Stefan?
Yeah, I'm being attacked by my cat. I just think, I must admit, I haven't looked at it in a great lot of detail. We discussed it very briefly, Liam and I. But it's just an opportunity taken by the company. We have to remember that these are historically low interest rates. And I think a lot of companies will be looking to raise some debt in this environment and take opportunities as they come around.
Question for Mike. Mike, two questions for you. Given a constructive outlook on NASPERS and process, which one would you hold, NASPERS or process? And second question, can you talk a little bit around Cell C and Blue Label and whether you see any value there?
Just thank you for the questions, first of all. I strongly favor NASPERS over process. Currently, NASPERS, as I mentioned earlier on, is trading at a discount of just over 50% to its net asset value. Process is trading at around 33%. The two of them are, to all intents and purposes, identical in terms of the assets to which you gain exposure. And I believe that following the inclusion of process in the Eurostoxx 50, it's not obvious what the next kind of big catalyst would be for any narrowing of the discount there. So I believe all of the optionality lies really in NASPERS in terms of the next step, in terms of the unlock of value. As for Cell C and Blue Label, certainly I think at this stage, Blue Label has effectively written off the whole of Cell C. So, in terms of further pain that you could see coming through there, I think that it's finally reached the end of that. I personally am a little bit skeptical of the long-term strategy of an MVNO number 4 mobile-only player in South Africa. I think management are certainly going to make a good fist of it, and if they get recapitalized, it's going to be an interesting ride. But I personally am a bit cautious. I see this as an industry where it's absolutely a scale game. South Africa, a highly penetrated market. And, as a result, I really struggle to see the sort of long-term story in Cell C. That's very much my own personal opinion. But certainly, I think the recapitalization of Cell C and the improved perception of kind of risk around that, I can only see as potentially good news for Blue Label. I think they've taken all of their medicine.
I think last round of questions, Saleo, is Northern Platinum a share that can produce more returns in the future?
Yeah, Northern is a share that we like. If you compare it to some of the other PGM competitors or peers of Northern, it has a much more attractive volume growth story in comparison. And there was an announcement, I think it was last week or the week before, that they're looking to accelerate the maturity of their BE transaction. At the moment, they own, I believe, 70% of Zambezi Pref shares. So I think once that's sorted, they should be in a position where they can return cash to shareholders quite aggressively if these PGM prices hold up. Of course, that's always the big if, but I think they're well placed.
Final question for today. This goes to Glenn. Glenn, does City Lodge survive after the disastrous BE deal, and what is the probability of another rights issue?
Yeah, so I don't really categorize City Lodge as a property company in its purest form, but we have looked at it, in terms of the stocks that we cover, and essentially from a South African point of view, it's absolutely in the eye of the COVID storm. The kind of travel and leisure sectors have been the hardest hit, but therefore it makes it more likely to bounce very significantly in terms of normalization, in inverted commas. So I think that you've got to put it in the bucket of airlines and those types of stocks that have really been smashed by COVID. But I do think it's a survivor. Might it have to come to market? Yes, that's a tough question because it depends when the vaccine hits our shores, I guess. But it may, yeah.
Guys, the time is 3:02. I'd like to thank you all very, very much for attending. I'm sorry I couldn't get to all the questions. Please feel free to email me, and I'll pass on any questions that you may have to the team, and we'll come back to you. Otherwise, we wish you from Anchor a wonderful December and a festive season, and we hope to see you at the next Essentials in January. Thank you and goodbye.